All right, hello and welcome to Camel Finance. I'm your boy Camel, and today we're going to be talking about how to manage risk as a trader. Now, it's important for me to point out that a lot of people have heard all these key terms like risk happens fast, and the number one thing a trader must do is manage risk. But not a lot of traders actually know what that means. Not a lot of traders actually implement it, even if they do know what it means. So today, I'm going to try to illustrate a very simple technique which ultimately comes down to keeping your stop losses smaller than your wins. And I'm going to show you mechanically how you can do that, okay? The importance of understanding why you must do that. Otherwise, you're simply not going to make it in this game. So I'm going to show you a couple of simple rules and tricks that you can implement. And what you'll find is, like everything I do, it's incredibly simple. However, it's simple to say it, it's simple to grasp the concept. It is not simple to implement it. It takes great discipline. Now, with time, you can train a good habit, right? If you are the sort of person that doesn't work out very often, the first 1, 2, 3 trips to the gym could be quite difficult for you to find motivation. But once you have built momentum, once you have gone every day for 2 weeks, by the third week, it is now integrated into your routine and it becomes much easier to go. The same is true of trading. If you train a bad habit, it becomes very, very easy to routinely make that same mistake over and over and over again. Similarly, in trading, if you build a good habit, it becomes very, very easy once you have repeated this good habit to ensure that that good habit becomes ingrained in your trading style and trading strategy. The risk management that I'm going to cover today is the number one thing traders get wrong and never ever master. Mostly because, and this is a bit of a harsh truth, a lot of people have gambling problems. A lot of people can understand these concepts, but when it comes to managing risk, when it comes to sizing their trades, when it comes to betting on stocks or crypto or whatever the asset class is, they cannot help themselves but oversize on their trades. Of course, if you oversize, then if you're wrong, and you're going to be all the time in trading and investing, you're going to end up taking big chunks out of your account, and those big chunks ultimately lead to mediocre performance at best. So the number one point I want to start on and finish on is that likely all you need to become the trader you have always dreamt of being is to understand how to manage risk. Not just to understand it, but to train it as a good habit and then to implement it into every trade you ever make from this point on. There's good news here if you're a brand new trader. If you're a brand new trader, you can implement this and you haven't got to go through the pain and the hardship of undoing months or even years of bad habits that have been trained. If you're a more experienced trader and you are in the kind of neighborhood of traders that makes some money, gives it all back, makes some money, gives it all back and some, makes some money, gives it all back and some. If you're this kind of trader, right, that has mediocre at best performance, then this is the one thing that is likely holding you back. So understand how to manage risk and you will likely be the trader that you have always dreamt of being. It's important to understand this. TA is essentially worthless, okay? Anyone can learn TA. Now you can learn very complex TA and you can learn very basic TA. You can also learn anything in between, and it really doesn't matter. When I say TA is worthless, it's important to make sure we understand why I have this approach, okay? I could teach you how to do my style of TA, or we could have multiple hours a day lectures for weeks and weeks, and we could learn a far more complex system. But ultimately, if you do not manage risk correctly, if you do not size your positions correctly, then all of that hard work that you do with understanding TA, all of the work that goes into producing a TA system that can give you reliable buy and sell signals is completely worthless because you're still not going to make money if you don't manage the risk accordingly. So as traders and investors, a lot of people spend a lot of time, whether you're an investor that reads company balance sheets and tries to understand where revenue and profit growth is going, or whether you're a technical trader like me and just tries to figure out the best way to find buy and sell signals based on the charts. No matter how hard you work at those type of things, you will never be a good trader, you will never be a profitable trader if you do not correctly manage risk. So this is likely the number one thing that you are missing. And as I said at the start, train this as a good habit and you will become the trader you have always dreamt of being. So I'm going to draw 2 equity curves, then we're going to talk about this whole flip a coin analogy, and then we're going to dive deep into this. So number 1, the 2 equity curves, right? This is what a trader's equity curve should look like. You should take a trade, make some profit, and then perhaps you make a following trade and you get stopped out. Only to take another trade and make some profit, pay a stop loss, and then resume higher from another profitable trade, only to pay a stop loss, a second stop loss, even a third before we resume higher. And you'll notice that over time, we tend to be up and to the right. This is what a trading account should look like if one correctly manages risk. However, and I suspect for most people, this next equity curve will be very close to home. Most traders and investors' accounts look like this. Make some profit, give it all back. Make some profit, give it all back. Make some profit, give it all back and some. Okay, make a little less profit, give it all back and some. This is all too familiar. And as I said, the only difference here really is that the second group, the mediocre, sideways performance, is the group of traders that do not correctly understand how to manage risk. If you want your account to grow in this fashion, then you must understand this risk management rule. And the analogy here, okay, is if we say we're going to flip a coin, okay, and you are going to lose a pound if you're wrong, and I'm going to give you a pound that you will win if you are right, would you build a business off of this? And of course the answer is no, you wouldn't. However, if we change the odds slightly in your favor and we say, if you flip a coin and you lose, you're going to give me a pound, versus if you flip a coin and you win, I'm going to give you £4, all of a sudden you start to think, over the long term, I could probably turn that into a profitable business. So again, I like to reiterate before we move on, very simple concept. Implementing it requires discipline and focus. It is implementing it that most people simply cannot do. If you want to be a profitable trader, just make yourself the promise now that you're going to be more disciplined than the rest of the people watching this video. So when I talk about managing risk, what exactly do I mean? I mean 2% maximum risk on a stop loss. If I am stopped out of a single trade, the maximum it will take out of my account is 2%. This means if I am trading with a $10,000 account size, the maximum stop loss I can afford to take on one single trade is, of course, just $200. Now ask yourself, how often do you, assuming you have a 10K account, take a trade where if you're wrong, you're only going to take $200 out of your account? For most of you, the answer is never. Most people, if they are wrong on a trade, are taking significantly larger losses than 2% per trade. Another rule I like to follow is the 6% in the sector risk. So I will tolerate a maximum of 6% across the same sector. And there is a good reason that 6% should be the absolute maximum risk anyone is willing to take in a single sector. You can see here from this table, okay, in the left-hand column, this is the loss, 5, 10, as you can see, percent. Now, what's interesting is, if you keep your losses contained to a maximum of 5 or 6%, you only need ever so slightly more than 5 or 6% of a gain to get back to break even. Meaning, of course, if I take a 6% loss on the way down, I need just about 6.25% return to get back to break even. But the moment I start to tolerate risk beyond 5 or 6%, you'll notice that at 10%, it takes 11% gain back to break even. But a 20% loss from a stop loss takes 25%. And as you see, the further we go down this list, by the time we get to a 50% loss that we have accepted, we need a 100% gain just to get back to break even. And of course, at the extreme end of this, 90% drawdown requires a 900% upside move to get back to break even. So by containing losses to no more than 6% in a single sector, and to no more than 2% in a single trade, we do not allow for the percentages to work mathematically against us, making it harder and harder and harder to recover losses. By containing losses to a maximum of 6%, we do not need to achieve super performance next time we're right in a trade just to get back to break even. So again, if you've got a £10,000 account, the maximum you should be risking on any single trade is £200. That also means if you've got a £1,000 account, the maximum you should be risking is £20. And of course, if you were to have 3 stocks, perhaps from the technology sector, then you could tolerate a maximum of 6% risk across all 3 of those positions without mathematically harming yourself. That really is it, okay? Now again, super simple to understand. I doubt you're sitting there scratching your head. Is it hard to implement? Yes. Now, here's why. There's a bunch of excuses people will make. And there are a bunch of excuses some of you are likely making right now. Some of these excuses include, but are not limited to, having a smaller account. And I've put greed here because this is the kind of attitude that says, well, I don't have $10,000 in a trading account. I don't have that much money. So instead, I'm going to start my account with 1,000. But for many positions, for many instruments, you will need a stop loss bigger than that 2% if you only have a smaller account. So rather than sit on the sides and allow these positions to go by and only select carefully positions that you can indeed manage with a 2% stop loss, you decide to get greedy and say, well, I don't want to miss the move. Okay, I don't want to miss the move. I'll just have a 20% stop loss on this one trade because I'm sure it's going to work out. Okay, again, If you are not trading with a 2% max risk per stop loss, then you are only going to end up with an equity curve that gives all of your profit back. Another excuse you will hear traders and investors make is smaller account, good intentions. This sounds a lot like this. I'm just going to trade big whilst my account is small. Once I get to a $10,000 account, then I'll start to manage risk, okay? This is good intentions. This is understanding that maybe I need to take more risk in the early days, and once I get to a $10,000 account, then I can start to trade with proper size, only £200 or $200 risk per trade. The problem is, in doing so, you are training bad habits. You are training yourself to what? Not manage risk, not respect risk. Assuming you even somehow manage to luck out and you turn a $1,000 account into 10,000 pretty quickly, well, now you've got a larger account and you still have not trained the good habit of how to manage and respect risk. You know what comes next, right? Well, it worked last time. Why not do it one more time? Again, you can see this all sounds a lot like being a gambler versus up here where it sounds like being a professional. People also make excuses time and time again. Again, it sounds a lot like being a gambler. They're confident. Well, it's Bitcoin. Bitcoin's going to go up. I can afford to trade bigger. Absolutely not. And if you look at your equity curve, that will tell you if you know what you're talking about, of course. Other excuses include, well, I just won the last 3 trades. Okay, so I'm pretty good at this. I know what I'm doing. My system works. I can trust my TA. If I flip a coin and it comes out heads 3 times in a row, does that mean the coin is on a hot streak and is certain to turn up heads on the 4th flip? Of course not. And similarly, this applies the other way around as well. You will hear people say, well, I just lost the last 3 trades. No chance I lose the next one. Or I just lost 3 trades. Now I've got money to recover. Better trade larger so that I can plug the holes that I just put in my trading account from these 3 losses. Again, if I flip a coin and it comes out tails 3 times, what is the probability of the next trade working out for me? Of course, each trade is independent of the prior one. So don't allow yourself to make these excuses. Okay, there is no excuse. You either know how to manage risk, you either respect risk 100% of the time, and you either never allow yourself to ever take more than 2% account loss on a single trade, or you don't. And if you don't, then again, it goes back to having this equity curve with mediocre performance at best. I want to make a couple more points because I know a lot of people get very disheartened by this. A lot of people say, oh, I just don't have the money, right? I need to trade bigger size. It's going to take too long for me to build a decent sized account. And ultimately, we all want it all now, right? We all want it as fast as we can. But this is a critical mistake that most people tend to make. And that is they tend to massively overestimate what they can do in the short term and massively underestimate what they can achieve in the long term. If you start with a $5,000 account and you get 30% annual interest rate, over the long term, 30 years, what you will find is you are capable of producing results that right now our linear brains are incapable of comprehending. Bitcoin, for example, has a compound annual growth rate currently around 70%. And if we change this from 30 to 70%, believe me as a trader, 70% a year is more than achievable if you can learn to focus on respecting risk and not give all your profits back. From just a $5,000 investment, 70% a year for 30 years. And this number is absolutely staggering. This is what I mean, right? People tend to vastly overestimate the amount they can make in the short term because they don't want to play for the long term. Learn to think much longer term. Learn to understand the power of hitting consistent results over a long term. And you are only a few years away from starting to make the money that you always dreamed of making as a trader. Do you realize, again, if we start with a $5,000 account in just 1 decade, we are sitting at $4.5 million, okay? But the only way you get there is you must respect risk. You must think longer term and you must focus on being consistently profitable. Every time you do this for a while and then get confident with yourself, okay? Then start to think, I know what I'm doing. I've just won 3 trades. I'm the best trader to ever touch the charts. It's time to start applying more leverage and size. Well, you know how it works, right? Then you're going to end up getting stopped out, taking a big chunk significantly above this, working mathematically against yourself. And instead of allowing compounding interest to work for you, you have now set yourself back by potentially years. Perhaps a more reasonable idea here is to start with $10,000, aim for 45% return, which for a trader is very doable. And you can see if you have 30 years ahead of you, okay, again, the numbers do not compute. But even if you only have 15 years ahead of you, you can still massively change yours and your family's life so long as you can learn to respect risk. Like I said, the concepts in today's video are not difficult to understand. You already know exactly what I'm talking about. The difficulty lies in training these as good habits. So I'd like to finish as we started, okay? This is likely all you need to become the trader you have always dreamt of being. This is the number one thing traders get wrong and never master. All that TA and stuff you do, anyone can learn in 15 minutes. It doesn't mean anything. So why then, if everyone is so good at TA, does nobody ever get to reap the long-term benefits? The answer, of course, is because they do not respect or manage risk. Apply these rules in your trading strategy. 2% maximum stop loss of your total trading account per one trade, and a maximum of 6% risk in any one sector. So if it's crypto, if it's technology, whatever it is, no more than 6% risk. Because like I said, it starts to work mathematically against you. And think long term. Do not overestimate what you can do in the next year or year and a half. Start to ask yourself what you can achieve in the next 10, 15, or 20. And I promise you, if you apply this one rule, you will be able to achieve the performance you always wanted to achieve.